Hi, this is Jim Sackman, your Focal Point Business Coach, and this is another of our Success Friday videos. We're talking about financing your business, and in this case, we're going to talk about lines of credit. Now, last week I talked about factoring, which is a cash flow solution, and lines of credit are a very similar type of mechanism in terms of the way they're used. They work very differently. Now, really, the topic we're talking about here is a thing called working capital. And working capital is the amount of money you've got to have in the bank to be able to deal with the fluctuations of cash based on you having to pay expenses to deliver products and services or until you get paid for your products and services. Now, many businesses, in particular retail businesses, have not much of that in terms of delivery from a customer because they take credit cards and cash, which turn very quickly into results. But they have inventory they have to stock, and so it's that inventory to cash kind of timing. Okay. So what's a line of credit? A line of credit is essentially a pre-approved bank loan. And it's pre-approved up to a certain dollar amount. And what that allows you to do is if you need to have some extra cash for a short period of time, you can draw on that facility. In other words, take some money out, put it into your accounts, and pay the bills. Now, your interest starts at that time, and you becomes very much like a standard bank loan where you pay interest and principal until it's all paid off. One other fee is there's very likely a filing fee and a maintenance fee for this kind of facility. So you'll pay some small amount of money to keep it available to you on an ongoing basis. Now, in general, the interest rate of these loans is somewhat higher than a standard business loan, but lower is a percentage than looking at factoring as a loan. So you can think of it as kind of like having a credit card at a relatively low interest rate. Credit cards work in many ways a similar way. It's instant credit. It's pre-approved up to a certain amount. But the interest rates on credit cards, unless you're going to pay them off in 30 days, are quite high. So, you use credit cards where you need to, but in general, you don't want to use them because of their interest. Now, if you end up using lines of credit or some of these other means on an ongoing basis and keep a balance there, and you have to look at how much cash you're keeping as working capital because you may need to increase it. Because it's cheaper to have the working capital on your balance sheet than it is to borrow at relatively higher interest from other people. So these are generally unsecured loans, which means you just guarantee that you're going to pay it back. They're not a secured loan, which means generally, although there are secured versions, which means you have assets which you would have to turn over in case you didn't pay it back. So there we go. That's all about lines of credit, and most business banks have. And you have a great day. This is Jim Sackman from Focal Point. Change your business, change your life.